Hello everyone and welcome to our YouTube live, and we'll be here for an hour. We'll answer your questions and let me just kind of recap what's happening in markets at the moment, which I think is interesting. I think the story with Evergrande is very important. Now this is a Chinese property developer which has borrowed a lot of money, very much like other Chinese property developers. And unfortunately, it's going to possibly go bankrupt. That means that it's got a big coupon payment on its debt, which is due on, I think it's the 23rd of September, so it's next week. And if it fails to pay that coupon, remember when a bond coupon isn't paid, then a company it goes into default, and that can trigger a bankruptcy. And if you've got credit default swaps, they can be triggered by that credit event. And it's already the case that some bank loans, which is taken out as well to raise capital, it's been explained that those are not going to be paid for this month. So I think it's pretty clear that this is going to have fairly large repercussions, because a lot of this debt, a lot of its capital structure depends on wealth management products. Now, these are just mom and pop people who invest in things like property in order to generate yield. And so obviously the people who are on the hook are not ultra rich people. They're people like you and I in China. So it's generated a lot of anger, which is justified, I think, in some ways. And many properties, $1 million properties, which have been discounted, have not been able to be sold. So I think it's a really clear case of oversupply in the Chinese property market, and there's going to have to be a large-scale restructuring of that market. Perhaps the government's going to step in. Initially, it's going to be a municipal problem with Evergrande, so the local government is going to potentially have to do something, but the municipal balance sheets are also stressed because those have also been overspending in some regions. So I think that's the worry, that the federal government is going to have to step in and bail out Evergrande. And then there's a question of moral hazard. Why could they get away with it? Maybe people should just borrow as much as they can because they know that if they're a big company, the government's just going to step in and rescue them. So there's this kind of classic credit crisis recipe, if you like, in China. The big difference is that it's not a democratic government. So the government can step in, Deus ex machina, and fix things. And it's a question of whether they want to do that and what message that sends out to other companies. So perhaps as part of the new way of doing things in China, they will do something, and it will be radical, and it'll shake up the entire sector. I don't think they'll say that the sector can't make profit. That would just be catastrophic, like they did with the education sector, the tutoring sector. But I think they may well certainly knock a lot of these very large property developers into shape and reduce their credit dependency, because they want to avoid a credit bubble. They try to deflate the Chinese credit bubble gradually, but it's looking like accidents like Evergrande are going to become more frequent. So that is a worry. Now the question is that going to spill into markets more globally? Certainly doesn't look like it at the moment. The S&P was up a bit today. We've got a triple witching week coming up when you have expiries of options and futures. And that often creates some volatility in markets. But we'll just have to see how contained this problem is and whether it's going to spread to the broader Chinese market and then beyond. But it certainly doesn't look good. Put it that way, when a company of this size defaults. Right, anyway, so that's the Evergrande story, and I can move on to your questions now, and also maybe tell you about what we've been talking about. So I did a video on leverage funds, which have just gone on to YouTube, and leveraged ETFs, which you might find interesting. That was our most recent video. And for Patreon supporters, remember they get lots of members-only content. There was a really interesting question, wasn't there, this week about
how equity and bonds will react in different scenarios, most likely scenarios.
There we go. So we looked at 3 scenarios which the question asker provided us with to see what equities and bonds would do in those three macro scenarios. And I kind of describe it as really good scenario where growth is good, inflation's there is transitory inflation, and then you get to reasonable growth afterwards. So that's the kind of Goldilocks scenario. Then we had a kind of middle scenario where growth wasn't so good, but inflation doesn't get out of hand. And then we had a kind of stagflation scenario where growth is lousy, inflation is high and it stays high. And we were looking at which assets would be best in those three scenarios. And I think this kind of exercise is a really good one because it kind of tests your understanding of macro to understand where you should allocate in those three scenarios. And in the third scenario, the nightmare scenario, stagflation, it's actually pretty difficult to find assets which will do well. Really you're restricted to inflation-linked bonds, I'd say. But anyway, that's a members-only video which has gone out this week. And if you support us on Patreon, go to patreon.com/PensionCraft. You can get access to that and all the dozens of other videos. There must be about
hundreds.
Must be not much less than 100 videos that you can access, which are members-only content. So obviously, I put a lot of work into the community. I mean, they're practically our family. So that's the way we think of it anyway. And if you join us, also, you can support us and make sure that we can continue to eat, including my beautiful cockapoo Teddy. Yes, these snacks, care of PensionCraft. So, back down. Goodbye. So that's our community, and I think it's quite valuable. People tend to enjoy it, and you get access to Slack and ask questions of me and other members of the community, and that's what we do. And then this is obviously a sideline, but you've got me for an hour, 52 minutes now, and I will answer questions. The people whose questions I answer first are the ones who support us on YouTube, because they have a little crown next to their name, and that's how we know that you're a supporter on YouTube. And so those are the questions we'll answer first. So Laura has flagged the first question from Thomas Crew, who is a supporter. Thank you, Thomas. And you can become a supporter during the call, or if you just want to give us a small amount of money, a super chat also gets pushed to the front of the queue with your question. And of course it feeds Laura, myself and Teddy. So Thomas says, any thoughts about the ongoing tug of war between value and growth? Yeah. I mean, this is like the classic struggle, isn't it? It's like yin and yang, or the Epic of Gilgamesh. So the two classic investment styles. And I think people were kind of excited about growth finally giving way to value at the beginning of this year. It really looked like it was going to happen. And if we look at the factors, so here I've got Koifin, which I'm going to share in a second. Let me share my screen. Here we go. And I'll stick myself in the bottom left. And here's Koifin. So this is a Bloomberg-like app, which is actually pretty useful. So this is one of their screens which compares factors. And this is for US factors. And if we just look at large cap growth and let's say small cap value, because those are two which kind of or actually let's just look at value and growth initially. So you can probably guess which is which. The one which is doing extremely well is value. It's growth. But if we go back a bit further in time, so let's say we go back 5 years or maybe 3 months. So IWF is the growth fund. So it's a growth ETF. And the blue line is IWD, which is a value fund. And you can see that the kind of false dawn that we had. So let's go year to date. It looked as if value was finally going to win. So it did have a brief spell of outperformance at the beginning of this year, but since then, since about June, it's kind of tailed off and growth has kind of bounced back. So it's those mega cap tech stocks like Amazon, Google, all the FANG stocks are the ones which have done well. If we go back 10 years, then you can see that growth has done pretty well through that entire period. It's only if you go back, say, 100 years that you can see that this is the weird decade when value hasn't done well and growth has done exceptionally well. So I did do a video on factors recently. So if you want to have a look at that, that was the video before the one I did on leveraged ETFs, where I said that actually quality is a really good style of investing. It's not listed as one of these, but quality is a very good style because it doesn't have big drawdowns, unlike value and unlike growth, but it does do fairly well. It outperforms fairly consistently over time. So quality would, a quality fund would be one where it chooses stocks based on a high return on equity. So for every dollar that you put into the company, it generates a high return. It goes for companies with very little leverage or less leverage than their peers, because taking out too much debt in the case of Evergrande is sometimes a big mistake. And it looks for steady, consistent profit growth, because that's what drives, that's the lifeblood of a company. And just those simple screens based on those three different factors, if you look at the MSCI Growth Fund, give fairly good, consistent outperformance of the S&P. And here we're talking about US quality. But anyway, take a look at that video and you'll see what I mean. But yeah, recently, very disappointing because I thought it was going to be a renaissance for value, but that doesn't seem to be the case. So we may have to wait longer for that to happen. I think it probably will happen eventually, but certainly there's no sign of it at the moment. So let's go back to your questions. I hope that answered your question, Thomas. I guess the other point is that, when would value outperform? The reason why I think tech companies have been so good at outperforming value is because they've been so innovative and they've managed to make themselves part of our everyday lives. Things like Google, Facebook, Amazon, you really have difficulty getting through a day without using one of those services or any of the social media, for example. So that's why I think they've been so successful. They've simply changed our lifestyle, which is pretty impressive if you think about it. If you go back just 20 years, the way we live now would be pretty weird if you think about, the innovations that we live with every day. And, the pandemic has certainly accelerated that trend to remote working, more dependence on social media, because when we were locked down, that's pretty much all we had to do. And streaming video, all of these things that were kind of happening already, it kind of pushed it one step further. So I think that's probably why it's been so successful. But I think at some point they're going to saturate their markets and then the growth will switch to elsewhere. Where that'll be, I don't know. But I don't think it'll be the US and I don't think it'll be tech. But, I don't make forecasts, but I know that history tells us that sectors which are exceptionally good, like railroads, if you look back to, over a century ago, 50% of the US market and the UK market was rail companies, because that was the new hot technology. But now, what fraction of the S&P is rail now? Probably 1%. So I think eventually it's going to change. I just don't know when, and I don't know what the replacement's going to be. My guess would be, if I had to guess, the sector that would probably grow a lot is something like mRNA technology, because I think that's going to transform us physically, and it has the potential to solve a lot of diseases, things like cancer. Imagine a vaccine for cancer, and because it allows you to tailor antigens very easily. And now that we've got these delivery mechanisms, which were honed in the pandemic, there's a huge amount of innovation that's about to come out in that sector, I think, which could really transform us as a species. But yeah, I think that's potentially one sector which really could come to dominate biotech. But anyway, back to your questions. Right. So, Susie Truck says, if you could only choose 3 generic ETFs, one for Europe, one for the US, one for Asia developed, what percentage would you buy of each? Interesting question. So, I guess Asia developed would be mostly South Korea and Japan. So maybe that would be interesting. I mean, one of the things you don't say, Susie, is the kind of time period we're talking about. Certainly if I was looking, say, if I had to just put money into the funds and leave it forever, I'd probably choose Asia, because Asia developed is soon going to include China. And I think many other countries will transition from emerging to developed in the next decades ahead. So if I had to build a portfolio for my family, I think I'd probably choose a big Asia developed allocation. So maybe 70% Asia developed, 20% Europe, and 10% US, because the US currently is very highly valued. So if I was looking at a kind of very long investment horizon, I'd probably do that. If we shorten the investment horizon to maybe a decade, that's a different story, because yes, the US is overvalued, but I think it still has this momentum as they've transformed our lives and become so integral to it. And I think it'll take a while for them to saturate earnings. So I think, over a decade, I'd have a bigger US allocation, probably closer to market capitalization. So, market cap would be, I guess these are all developed markets, so market cap would be about 60% for the US. I'd have a little bit less than that, maybe 40% US. And I think this 40% US, 40% Asia, and 20% Europe, something like that. Because I think, in this tug of war between Asia and the US, it's not clear who's going to be the winner, and I suspect they'll both do well. So, roughly equal Asia developed and US. And Europe, it's harder to see Europe doing incredibly well, because one thing is it doesn't have these unicorns which you see in other developed markets. So for the US, for example, they're incredibly good at venture capital, generating innovation, funding it, winnowing out the bad companies, destroying them effectively, but letting people, entrepreneurs, fail and then try again, because I think that's critical to the kind of VC process. Whereas in other places like Europe, failing is seen as a kind of stigma. And I think that's a huge mistake, because if you have a company, you found a company, you learn from your experiences, particularly if you're young, and next time round you'll probably do much better with your company. So that's why I think that the culture in America is much better, because it allows this kind of serial failure so that eventually you can succeed, and it provides the capital for that, which we don't see in Europe. So that innovation is key. But we are starting to see that in China too. But it looks like the government is being much more heavy-handed in deciding which sectors are allowed to succeed. So if you're working in the chip industry, for example, generating, designing and making silicon, then I think that falls squarely in the sights of the Chinese government as being okay. So I think we should expect to see huge amounts of innovation in that sector from China. Whereas in the US, it's much more touchy-feely social platforms, what kind of just seems to do well in America. So I think there will be this split between the two poles of the world, the eastern pole, the western pole, they'll compete for technological supremacy, and I suspect that both of them will do fairly well, and eventually they'll come to some kind of symbiotic relationship where a lot of the tech, a lot of the hardware comes out of China, even though Europe, for example, is trying to build its own chips, as is the US, and succeeding obviously in the US. But I think a lot of the innovation is going to come from China. And it would be a mistake to kind of not use the hardware, but still, we'll have to see what happens. But that's the way I'd split it. Susie, very long answer. Next question.
There's one in Slack.
Laura says there's one in Slack. This is from Andrew O'Connell. Thank you for asking. Was it as a supporter? Mm-hmm. So thank you for supporting us on YouTube, Andrew. He says, hi. For my UK allocation next year, I'm thinking of using LG UK, which I think is a legal and general fund, which tracks the FTSE 100, and PR UK, cheaper than all share for me. PR UK appears has done very well. Is the UK past reflation, boom, Brexit hangover? So let's take a look at those funds actually, because that's kind of interesting. Let's look at PR UK, and I'll pop this up so you can see what I'm doing. Right, and I'll stick myself in the bottom left again. Here we go. So this is PR UK. So this is SharePad. This is the app that I use, which you can get a affiliate link to if you want. There's a usually it appears in the description of the. Does it?
Yeah.
Yep, it appears in the description of our video. So if you want access to this, you get a discount if you use our affiliate link, and you get to feed us, which is great. But it's pretty good. So let's have a look at this fund. So the ongoing charge, 0.05%. I love that already. And fairly big, 128 million for a UK fund. 12-month yield, 0.2. So it's not giving us yield, but it is giving us capital growth, which is interesting. If we look at the portfolio, we can see that its size is kind of mid-cap. It's gone for a blend of value and growth. And the PEs aren't particularly high, 19.4. And if we look at the sectors, actually let's look at the countries first. It's 95% UK, so this is a UK mid-cap fund. And it's interesting, if you look at the UK mid-cap sector, a lot of it is asset management. A lot of investment trusts fall into that category. A lot of capital markets, a lot of aerospace and defence, industrial machinery, residential construction. So it's a fair old grab bag of stuff. Yeah, so I think that's an interesting way of getting the exposure. I mean, you could go for the small caps. If you're really bullish on the UK, you could go for some kind of small cap fund, because that obviously will have more exposure to the UK. And if we are entering a kind of boom period, then the small caps will do particularly well. And those are the ones actually which have done very well recently. So companies like Treat. I had one client talking to me, and he had a portfolio that was all small caps, which had done incredibly well. So this is the price of Treat. And he was telling me about Treat and about 5-6 other companies which he'd bought, which were all going kind of vertical at the time. And it just terrified me, because I thought, this guy, he's taking so much risk, because eventually this crazy rally is going to end. And sure enough, it now has for Treat. And it looks like it's starting its descent. So I hope he got out in time, if he's listening. But yes, your fund looks pretty good if you want to, going back to you. Yeah, your fund looks pretty good. If you do want UK exposure, that seems like it would be suitable. I'm not sure I agree with your thesis, which is that the UK's about to kind of do incredibly well. I think it has certain problems with supply chains, particularly. We're seeing it at the moment, and that's not likely to go away. Part of it is because of Brexit. You know, Brexit was a problem which has created this supply chain issue. It certainly made it worse, and so I think that's a problem, and it's not one that's going to go away. It's not something that would immediately be fixable, unless it's going to take a while to train up drivers, HGV drivers, heavy goods vehicle drivers, and get that infrastructure rolling again. And it's pretty shocking seeing empty shelves at the supermarket. You know, I never thought I'd see that in my lifetime in the UK, but there we are. So yeah, I think I'm not so bullish as you on the UK. But certainly if you're going to go for that, I'd go for a mid-cap, which is what you're talking about, with low fees, or a small cap fund. Let's see if I can find one actually. There is a small cap one I know. Let's see if I can remember the ticker. Yeah, it has an unfortunate ticker, which is CSUK. But let me just share my screen again so you can see this. Yeah, this is CSUK. And the ongoing charge is pretty high, but it is a small cap accumulation fund. So the dividends are reinvested. If we look at the fund, hopefully it's going to show us that, yeah, so this is value, but it's large cap. Okay, so it's not. Okay, so this is just a whole UK fund. This isn't the right one. This is large cap blend equity. Now, I was hoping I could find the ticker for the small cap one, but I can't. So I won't waste your time trying to find it. There we go. So yeah, I think that's a reasonable choice. That or a small cap fund. Keep the fee low, and let's hope you're right. Okay. Oh, another one from Gary, who's also a supporter. Thank you, Gary. Teddy thanks you. He gets a treat. Supporter. Supporter, Ted. Yes, treat. Good boy. And Gary's question, what do you think of Novi, a digital wallet from Facebook that allows you to pay across countries for 0 fee? Oh, Teddy's found the treat bag. You're not allowed the bag, Ted. That would be greedy. That allows you to pay across countries for 0 fee using dollar-pegged stablecoins. It uses blockchain-based payment system. I'd never heard of it, to be honest, Gary. I think that sounds interesting. I think a lot of these, I think a lot of platforms are going to start offering digital wallets. For example, I don't know why Robinhood doesn't do that, because I think that would be a real killer product if you had Robinhood combined with some form of digital wallet. Because instead of just being a broker, then, you know, it could also be an exchange for crypto, but it could also be used as a payment system. I think that really would be a killer app. And other brokers could do this. But I think Robinhood's fairly innovative, so perhaps they'll be the ones to do it first. But Novi, yeah, interesting because it's Facebook, because it's got lots of people on it. Lots of people check in on their Facebook accounts every day, billions of people, in fact. So that's really interesting. I hadn't heard of it. I'll certainly check that out. Yeah, nice one, Gary. I have to look at that. In fact, I was just making a video about stablecoins today, but it's in a negative light because a lot of regulators are looking carefully at stablecoins because I think they definitely could be a source of contagion for if there's a big sell-off, or if somebody pulls money out of stablecoin, it could trigger a sell-off in commercial paper, which could trigger a sell-off in equity. But anyway, whole video incoming on that. I was just editing the video just before this. But that should be a fun video as well. I'd like to see what people think of that one. Okay. Oh, we've got a super chat from Midnight Sun. Thank you very much. Who's given us £5. £5. Much more. Much better. £5 than $5. Super chat from Midnight Sun says, plan to invest a third of my portfolio to sector, country, single stock. Rest in boomer funds. Okay. Boomer funds like, I guess by boomer funds you mean things like an S&P tracker. That's the kind of stuff I'd buy. 2 funds for better fees, or take hit on ETF and stick to 1. Okay. Well, you don't say which sector, country, or single stock. So I guess you're asking me whether you should have two funds in order to reduce the fees. So okay, I see. Okay, you're making it as simple as possible. Should you just stick to one ETF or have two funds in order to reduce the fee? I think I did a video about that a while ago where I was talking about if you buy a global equity fund, the fee is much higher than if you buy a DM fund with a 60% with a 90% weight and an EM fund with a 10% weight, because that's roughly the market cap weighting you'd get with a global fund. And the overall fee for that was considerably less than the overall fee for a single global equity tracker for UK investors. For the US, Vanguard does have a global fund, which is very cheap. I think it's 0.08%, which includes EM and DM. But look, if you can get the same exposure for a lower fee, definitely split, because, why not? Rebalancing, you don't have to do very often, if ever. If you don't rebalance, the thing that does well just gets bigger. Not particularly worrying.
You just posted something else.
Oh, you just replied. So, China Biotech Thermo Fisher for 33%, World Index for 66. Okay, so you've got a kind of barbell portfolio. Interesting. Now, what that means is that you have a kind of low risk, safe plodder fund. So that's the boring bit of your portfolio, which is low risk. And then you have a high risk, potentially high return part of your portfolio, which is 33%, which is kind of exciting. China, biotech, Thermo Fisher. Interesting. I mean, I do a similar thing because I've got a kind of fund portfolio and I've got my Vanguard portfolio. And for the fund portfolio, I do crazy stuff, things which I'd never buy, which I couldn't buy with Vanguard, like 3 times levered funds, so things which are kind of weird. And then, I have a kind of low risk portfolio as well. And I never take very big punts on the risky stuff. It's just fun, really. But yeah, I think that's an interesting allocation. Personally, I think I'd go for the biotech. Probably a global biotech for my exciting 33%. Single stock, probably not, because you're taking a hell of a lot of risk if you just go for one fund, for one stock. So I'd probably go for a sector, probably biotech. China, I'm not sure. I can see why people are pulling money out of China. I think that story's got a bit longer to run. I'd probably wait to see the shakeout over the next few years for things like Evergrande and putting the kosh on tech companies like Tencent and Alibaba. We've got to see what the repercussions for that will be. I think China's got to go through this kind of transition phase when it's got to learn to live with these kind of companies, and maybe they'll be less heavy-handed in future. But I'd be very cautious about having a big China allocation at the moment. So biotech is the one I'd go for, and I probably wouldn't do a single stock. But low fees, no questions there. That's probably going to help you a lot. Okay, so back to your questions. And what have we got? Right, so if you do a super chat like we just had, like Midnight Sun just did, then you get pushed to the front of the queue and I'll answer your question first. Otherwise, I'll just work through these. Here we go. Here's one from Maria DC who says, "Hi Ramin, what figures or metrics would you have to see in the market to make you consider selling your equity investment as you did last year before the crash?" Yeah, I mean, the reason why I sold in February 2020 was because we had 4 successive quarters of no earnings growth in the US. And equity was just continuing to power upwards. And yet there was no earnings growth pushing it up. So, for me, that was a re-rating rally where you just pay more for every dollar of profit, and it just seemed unsustainable. I mean, I never would have guessed that a pandemic would actually create a huge rally. I didn't see that coming. So, I think for me, if that happened again, if earnings growth effectively stopped, then I'd be really worried, particularly in the US. But at the moment, what we're seeing is a year-on-year increase of 80% in earnings per share for the US, which is pretty surprising, right? Pretty amazing. You won't see that many times in your life. But if that starts to kind of ebb, so for example, I made a video recently about the 4 reasons for a potential crash. One reason would be if margins were eroded. So look at corporate margins, because if you look at the share of profit from companies which goes to workers and the share of profits that goes to shareholders, the split is hugely favouring shareholders at the moment. So the pendulum has very much swung from paying people more to paying back more to your equity investors. And in the US, that's been because money's been ploughed into buybacks. So if you look at Apple, instead of providing huge compensation for their staff, they've taken their profits and bought back their stock. And that increases the value of the stock, and the rest is history, right? For the last decade, we've just seen huge outperformance and capital growth for US tech, mega tech stocks. But I think if the pendulum swung the other way, if people started to complain about salaries and stopped doing jobs for low salaries because they thought they could hold out for a better job, and we are kind of seeing that in the US, there are lots of open jobs without people taking them. And that suggests to me that people are mismatched with the roles somehow, either because it's not paying enough or it's in the wrong place or the wrong sector. Whatever the reason, we do see this huge number of empty roles. And it might be that that's because people are not willing to do work for very low salaries. So if we do see the pendulum swing back, then more corporate margins will fall. Currently, they're at very high levels. Companies are making a lot of profit because they're not paying their employees much. And if we see those margins fall, then that would be a problem for equity valuation, for profits. And we are also going to have tax increases, according to the Biden administration. That was their policy when they were voted in. So these margins will be key. If they fall, if earnings fall, that would make me sell equity again. If it just stopped, if earnings growth just stopped again, that would be one thing. But generally, at the moment, what I'm doing is I'm building up my equity allocation to 80%. I'm currently, as of this week, I'm the 5th payment out of 24, because I'm doing it over a 2-year period. And if there was an equity market crash, I'd pile in. If equity valuations were below 5-10-year average for forward PE, then I'd pile into the equity market. I'd accelerate my equity purchases. But if, would I slow down the equity purchases? Probably not, because, you do want to be allocated to equity as much as you can for as long as you can, because you never know when the correction's going to happen. So valuation's really useful after a crash. Before a crash, not so much, because valuations can stay high for a long time. So that's it. I'd look at margins, I'd look at earnings growth, I'd look at valuation. All of those are the things I consider. But it would take a lot to stop me buying equity, because I'm pretty convinced that's the best thing to do long term. Any other? No. Alex Bastian, compared a few platforms, Hargreaves Lansdown, AJ Bell, Trading 212, using different devices at the same time, and was shocked that the quotes for buying or selling stocks or ETFs was very different. Shouldn't it be the same is the word that's missing there. The same or very similar. Seeing that, wouldn't it be better for long-term investors to stick to mutual funds instead of ETFs to save on the spread? I'm surprised they're very different, because I mean, look, if you can actually see the very granular data on a stock, an ETF or whatever, you will see different prices depending on which broker you talk to. And actually the size of the order affects the price as well. For small orders like the ones we do, the prices would pretty much be the same anywhere. But let's imagine your broker, we're trading 212. Let's say they've got one group of brokers they work with, and then Hargreaves Lansdown has another group of brokers they work with. Then it's quite plausible that the prices would be different because the order books would be different for those two brokers, particularly for illiquid stocks or ETFs. If it's a very popular ETF, very large market cap, I very much doubt that you get a very different price. If it's a small cap ETF or a small market cap ETF, which is just worth about, say, 20 million or something like that, then the prices would be more different. But for a huge fund, I'd be amazed if there was a big difference in price. So I think for long-term investors, I really wouldn't sweat too much about sticking to mutual funds because the bid-offer spread for large funds, I suspect, would actually be quite small. And you can actually look that up. I mean, you can get level 2 data, but I've never done that because I don't think it's worth it. But 1% difference, maybe. I really wouldn't sweat it for a 1% slip in the value of the fund when I buy it, because I literally will hold the fund for years, if not decades. So for 1%, I don't really care. But would that make a difference between choosing ETFs and mutual funds? Well, the thing I don't like about mutual funds is the different fees you pay for different classes. So if you actually look at the classes for a standard mutual fund or open-ended investment company, there are usually about 4 or 5 share classes. Each one will have a different fee according to how you buy the fund. Is it via an advisor or is it via a certain platform? Sometimes they create a specific class for a specific platform like Hargreaves, which has a different fee. Whereas ETFs have the same fee everywhere, which I like. So, I still think ETFs would be my choice. I don't trade intraday, so, the liquidity from an ETF, the additional liquidity makes no difference to me. But I feel kind of ambivalent about mutual funds or ETFs. I'd be happy with either. I'd probably just go for one which gives me the exposure I want at the lowest fee. That's the way I think about it. Because remember, the initial buying price is a one-off cost. The ongoing fee is forever. So that's the most important thing. So I'd focus less on the trade, which is kind of irrelevant or less relevant for long-term investors, and focus more on the fees because they're ongoing and they'll eat away your wealth forever. That's the way I think about it. Interesting point though, Alex. Thanks for sharing that. That's really interesting. I'd love to see those numbers if you could somehow somehow share them. It's very difficult in a YouTube live to do that, but yeah, do get in touch. I'd love to know that.
Yes, Gary in Slack.
Oh, so Gary's got another question. Gary's point is, isn't increasing share of profit for workers good for equity? Yes. Workers are also consumers, whereas investors are savers. Yeah, but okay. So, I think ultimately, it's a question of. Yeah, I think this is actually a political question because, the question is, would you rather have redistribution of wealth or would you rather have rich people getting richer? Because people who invest in equity, the people watching this channel now, are the ones which tend to be more wealthy. And if increases in share price happen, it makes those wealthy people even more wealthy relative to the people who are poor. Whereas if you have higher pay, then that tends to be more of a egalitarian way of distributing profits from companies, and it reduces inequality. So the question is, what kind of society do you want to live in? The one where you hoard wealth and make the rich richer, or where you distribute that wealth more evenly. And there must come a point at which the poor become really dissatisfied and there's kind of social unrest. And eventually that happens, right? If things get really extreme. So, and justifiably, if people are seeing that they're getting no increase in salary for a decade, which was what happened in the UK for the last decade, they get pissed off. And that's a natural outcome. So to a certain extent, I kind of agree with you that, it's good for shareholders, it's good for me, but at a certain point, inequality becomes a problem for everyone. You don't want a kind of Pol Pot type scenario to evolve. Okay, next question was from James. Cool. Hi, Ramin. How would you go about gaining private equity exposure as a satellite portion of a portfolio? So here he's talking about core, which is the kind of diversified, boring bit, and satellite, which is a small proportion of your portfolio and exciting and potentially high return investments. So he wants private equity exposure in his satellite. I can see that the BG Schiehallion fund is available on AJ Bell, but there's a large premium to net asset value. Let's see if I can find it. Oh yeah, I can. Right, let's have a look at it. Because it's a good example of private equity maybe. So share my screen. There we go. Hope you can see this. So this is the Schiehallion Fund Limited. And yeah, so here's the fund and here's its performance. And you can see it's fairly illiquid, as you'd expect with a private equity fund. Recently, it's kind of gone vertical. And if we look at the financials, the expense ratio 0.8, so not great, but fairly standard for a private equity fund probably. If we look at the company and we look at the portfolio, so you can see that it's got fairly diversified. It's got 4 sectors that are listed here: information technology services, chemicals, healthcare plans, internet content and information. These don't add up to 100, which worries me. So I suspect there's a data issue here. But it says that it's primarily US. And so it's got a lot of preferreds in it, which is kind of weird. So I don't know what the theme for this private equity fund is. A non-cellular, closed-ended investment company. Its objective is to generate capital growth for investors through making long-term minority investments in later stage private businesses that the company considers to have transformational growth potential. So it's a little bit like Cathy Wood's or like Scottish Mortgage. Have the potential to become publicly listed. So it buys private companies, hopes they have a transformational effect. So these would be the future Apples and Googles and Facebooks. And if they do become successful and get listed, then the company can sell them for a profit. So fairly standard private equity story. It buys companies which are kind of fairly established, and then it tries to inject capital, perhaps helps them build their network, provides management expertise, some networking perhaps, and hopefully helps the company go to the next level. Interesting. Linda Yu, who's often on the BBC, I love her stuff. She's actually a non-executive chairman of the board. So I think she's cool. I love Linda Yu. And don't know any of the others. But yeah, cool having Linda Yu on the board. And here's the fund itself. Oh, it's a Bailey Gifford one. Interesting. They always go for good governance. But anyway, yeah. won't dwell on that. But that looks interesting, yeah. But if you do want exposure to private equity, there are also private equity funds, which, for example, there's one from iShares, which I think the ticker is IPRV, and that gives you diversified exposure to lots of the largest private equity funds. So again, if I share my screen and look for, I think it's IPRV. Yeah, so this is listed private equity. So if we look at their portfolio, their holdings, you can see that they buy shares in the largest private equity companies. So that would be companies like Blackstone, KKR, which is a very known private equity company, 3i, another one, Apollo, another famous one. So there you get exposure to all of them. And I guess the geographic exposure will be tilted to the US. I don't know if it gives that exposure. It doesn't. And the fee for this, I suspect, is pretty high. Let's have a look at the fee. Fee. Ongoing fee. Which I can't find. Standard deviation. Nope, it'll be here. Ongoing charges, 0.75. Yeah, so it's fairly standard to have a high fee for private equity. And this is obviously no exception. So I think that's another way you could go, right? So you could go for one of these funder funds, but just expect a high fee. Would it do exceptionally well? Not necessarily. Private equity doesn't always outperform. It's often the case that it doesn't, in fact, because of the fact that people pay too much for private equity because it's a lottery ticket type of payoff. And so that tends to push up prices. But at the moment, certainly, funding costs for private equity are very low. That works in their favor because they often borrow to expand a company. And if the fees for doing that are low, if the funding costs are low, that boosts their profit. So that's certainly in their favor. And there's also an environment of people willing to take who are willing to take risk. And in that kind of environment, private equity probably would thrive. So, yeah, I mean, that's interesting. But those are the fund you showed me is interesting, but so is something like IPRV. That's another way of doing it. And as you say, there's a large premium to NAV, which suggests that lots of people have been buying it. So it's overpriced. So maybe put it onto your crisis shopping list for something you'd like to buy if the price was lower. So if there is an equity market shakeout, that's the time you'd buy it, when it's valued at a lower price. Because the fundamental story probably won't change. It would be bullish. It just means you could buy in at a lower price. And private equity, remember, would be a long-term investment. You can't just dip in and out and hope to make a big profit. Great. So we've got 6 minutes left. 6 minutes left and see which questions we can answer. And oh, interesting. There's one called The Evil Divide. Good tag. Have been thinking about Japanese index, S&P funds. Is the uptrend temporary? 11% this month. So if we look at MSCI Japan, we can see the rally. And I was talking about this in the newsletter, actually. So I provide this newsletter every Friday. It's free to sign up for. And if you are interested, it's in the description of the video, how to sign up for it. But I was writing about Japan, so I'm kind of aware of what's going on. So let's use this fund and have a look at the performance. So let me just share my screen again. And back to SharePad. So what you were talking about, I guess, is this incredible rally recently. So for example, if we look at the last month or so and look at the percentage increase, it's up about 9%. It does seem to be leveling off a little bit at the moment. But the reason for this is because of the resignation of the Japanese Prime Minister. Um, and as a result of that, people are expecting that there's going to be a new leader in place who's going to do a lot more in terms of stimulus. And as a result of that, it would be great for the equity market. So people are talking about who could potentially win, but whoever it is considered to be a hell of a lot better than the guy who left. And if that does pan out, if there is a huge stimulus from the new prime minister, now that Suga has left, then that could be very positive for the equity market, and there could be another leg up if the right person wins. So I think there might still be some more juice in that trade, but just remember that a lot of people have floundered on the shores of Japan. Many strategists were very bullish on Japan, saying that this was it. This was the chance for Japan to recover. But you can see it has been fairly lackluster. So if we just look at MSCI Japan, if we look at MSCI World and just add that to the graph, you'll see what I mean. Teddy wants another treat. Yeah, you can see if I compare it with MSCI World, Japan has just been lagging horrendously compared to that because of the outperformance of the US for all the reasons we've discussed. So yeah, it's been a good run recently. It has outperformed recently, but the question is, is that gonna be sustained? So might be worth a punt, but I wouldn't take too much of a gamble on it, I think. So back to the questions. And Teddy keeps nudging me, so I think he probably wants another treat. Sorry, Ted. Oh, you caught up in the wire. Up here. Up here. Yes. Good boy. Right. So back to the questions. I think I've got time for one more question before we stop. Okay. There's a question from Rushar who says, "Hi Ramin, could you tell us where you get a lot of your data from, especially that data with PE ratios by country?" Right, so the PE ratios by country comes from Barclays. See if I can find it. Actually, let's have a look on PensionCraft. So if we go to frequently asked questions. Thank you. And every week, Sam Hill, who's our community manager, posts our frequently asked questions document where we have a list of all the useful stuff. So let's have a look at Barclays, and the CAPE ratio by country is listed there. So that's one of the useful things you'll get as a member of Patreon, and you'll know that you're feeding Laura and I and Teddy. So what could be better than that? So this is the CAPE ratios by country. I often refer to this data, and if we compare the US and the UK, you can see that the US is much more expensive than the UK, but it usually is, right? But anyway, yeah. So if you want to compare CAPE ratios across countries, this is a good source, and you can download the data. So I think you can export to CSV and then graph it in R, which is what I use, the statistical language R, or a package of your choice, Python. So that's how I get my data. But the other source of data which I use, of course, is SharePad, and there's an affiliate link in our description. So if you are interested in signing up for it, you get a month free. And if you go for the annual membership, your 13th month is free if you go for the annual membership. And we get a month free, I think, if you sign up. So yeah, please use our affiliate link if you do sign up for it. I think it's pretty good. I mean, obviously I use it in the YouTube lives because I can find prices very quickly, and it is useful for just looking at prices very quickly and exporting them into R. And the other thing I use is Fred, because for macroeconomic data from the US, it's just incredibly useful. So if I want to look up inflation, I just type in CPI, and it sorts by frequency of the frequency that people look at each of the time series. So immediately it gives me the most relevant time series at the top, which is the CPI for urban consumers. And then you can transform it, download it. I could look at the year-on-year change instead of the index, which is what people usually look at. And there you can see the mini spike in inflation, the transitory spike in inflation that we've had recently. And it's kind of leveled off now. So yeah, I think that's a great source as well. But for stock data, index data, some crypto data, yeah, I use SharePad. It's pretty useful. I find it extremely useful, and I've been using it since it was like a dial-up modem thing. When you dial up, and it used to go. So I've been using the product for over 20 years. It's pretty good. It's improved a lot over that time. Anyway, it's 8:02, so I think we'll wind up there. Thank you all for joining us. It's been great to have you, and brilliant questions as always. I just find it incredible that we get so many good questions, and thank you for supporting us by watching this, if you are still watching. And don't forget, you can subscribe. That helps us. You can also like this stream, whether you're watching it live or in playback later, which many people do actually. We get many more people watching it afterwards than we do live. And have a great 2 weeks. We'll see you again in 2 weeks' time. And thank you for watching. And good night.